Well, now I guess we move to the kind of session you should have at Bretton Woods, talking about the large architecture of the world financial system with particular focus on the questions of Asia. And leading this session will be, I would say, about a 27-year friend of mine, Paul Bluestein, who is a fellow at CG. So it's a bit of a home game for you. He's also a fellow with the Brookings Institution in Washington. Please welcome Paul Bluestein.
Thanks, Rob. Well, this panel has a pretty daunting challenge coming at the end of a long third day of this conference, and many of us are already suffering from jet lag. Some of us who came long distances, I came from Japan, so I know I've been suffering from jet lag. And then here we are starting this session nearly 10 hours after. I don't want to tire you out too much just to think about it, but 10 hours after the start of this morning's earliest session at breakfast. But fortunately, this is a session that is rich in potential for stimulation. First of all, there's the topic. I mean, here we are in this historic building, and cast your mind back to the time of the Bretton Woods Conference when White and Keynes had this vision of the world in which there would not be any, much money flowing across international borders at all. And that lasted for quite a while. I think it was Martin Wolf's book, great book, Fixing Global. I'm pretty sure I've got my source right there. That until the 60s, an English person couldn't take more than 50 pounds out of Great Britain, out of the country. So we're going to focus, not exclusively, but we're going to focus in this panel on. One area of the world where that sort of approach isn't quite as passé as it is in other parts of the world. And fortunately, we have a panel that's not only distinguished, but consists of people who come at this subject from quite disparate parts of the spectrum, which should liven things up and help you cope with that jet lag and going into the 11th and 12th hours of discussion. I mean, how often do you have a panel that includes one of the foremost, arguably the foremost, advocate of the proposition that markets are not only imperfect, but deeply flawed? I'm referring, of course, to Joe Stiglitz. And sitting on the same podium, the director of the Organization of Private Market Actors, the big banks, the securities firms, the insurers, the pension funds, whose actions, I'll just put this in as neutral form as I can as possible. They say their actions helped inspire the creation of INET, let's put it that way. And if that weren't enough, we have a former central bank governor of the world's second most populous country, now widely viewed in his own country as something of a hero, for having kept India shielded from the impact of the financial crisis by taking what might be called a very, very prudent approach to opening up of the financial markets and financial system in his country. YV ready. And finally, we have a leading expert on the world's most populous country, author of a book with a title that you really got to love, among his many other publications, Capitalism with Chinese Characteristics, Professor Yasheng Huang of the Sloan School at MIT. And two discussants, Mr. Yu Yongding of the Chinese Academy of Social Sciences, and Brad DeLong, who is a very distinguished specialist in economic history, but also the blogger, one of the very small number of blogs I make sure to never to miss. And if you read his blog, you know he won't be shy about being very forthright if he hears assertions that he finds lacking any sort of good grounding in reality. So as interesting as I know as they'll all be, they've been asked to view the 15-minute limit allocated to speakers as a ceiling, not a floor. You won't be penalized for going under it. And to help them use their time most efficiently, I will speak for all of us on the panel so that they don't all have to repeat the point that of wanting to thank the organizers of this conference. The accommodations, not only luxurious, but historic, and the organization has been so efficient. I mean, I think we can certainly say this now as the conference is coming toward the finish line. Most important of all, it's been a feast for the intellect. So without further ado then, Joe, please.
So I won't say it's a pleasure to be here, so I'd be preempted. Let me pick up with what Paul just mentioned, that the world is really very different from what it was when the Bretton Woods meeting was held here in Bretton Woods. It's changed in part because of the growth of financial markets that's already been referred to, but it's also changed partly by the role of the actors. India at the time was represented as by the UK because it was a colony. And so you had basically the whole British Empire represented by kings. China was still relatively weak, and we've heard a little bit about the role that they played. So the first point I want to emphasize is that there is this very marked changing global economic landscape. Unprecedented growth in Asia with rapid convergence. These are facts that are already well known. The important point I want to emphasize is that the economic model is markedly different from American-style capitalism, and this is especially true in East Asia. There's a larger role for government, more government controls, and especially in financial markets. So it's very clear that the Asian economic model has worked, and it's worked very well, not only in promoting economic growth, but also for stability and actually delivering the benefits to a very large number of citizens, reducing poverty, in many ways working much better than, you might say, the American economic model. Well, that leads to new questions about global economic governance. The combination of their success and their economic role in trade, finance, and reserves implies that Asia should, and almost inevitably will, have a larger role in setting the rules going forward. But there are marked differences in interest, in economic circumstances, and in ideology, which should imply that the rules that were set not only in Bretton Woods, but by the advanced industrial countries over the last 20 years, may not be the appropriate rules going forward. For instance, before the crisis, the Asian countries were put under pressure to adopt unfettered financial markets, fully flexible exchange rates, and with one exception, in the East Asian crisis, it was actually interesting that China was put under pressure not to have a flexible exchange rate. That's a little detail that's often missed. And in fact, so much so that some of the rules, like financial market liberalization, are actually embedded in some of the trade treaties that US and Europe have been advocating. But of course, after the crisis, it's been recognized that excessive deregulation was responsible for the crisis, and financial and capital market liberalization may have contributed to the rapid crisis spread around the world. Now, some people in the US Treasury are continuing to say many of the same, advocate the same lines, that unfettered markets, free movement of exchange rates, et cetera, should still be the rule of the day, but there's very marked changes in the intellectual framework represented by this conference, but also in the policy framework represented by the conference at the IMF a couple of weeks ago and by the IMF paper that came out a few days ago on capital controls that I'll refer to a little bit later. So there is a new balance of global economic power, and it's likely that the rules emerging in the coming years may be markedly different from those before. And it also should be clear that it may be much more difficult to get agreement on what those rules should be. So what I want to talk about most of today are looking at a few of the key rules for the global financial system. The question is, the broader question is, will the emerging markets be able and willing to rewrite these rules to reflect their country's interest the broader interests within their society, not just financial markets, not just the interests of the big banks, promote global stability and growth in ways that the previous rules clearly did not, and rules that will promote development and the well-being of the poorest countries. So I'm going to talk about three issues very quickly, and focusing mostly on the second one. The first is the global reserve system, second, the global monetary system, and the third is the global regulatory system. The global reserve system is something that, again, we ought to be thinking about now that we're here in Bretton Woods. One of the hopes, I think, that at least some interpretations of what Keynes had hoped for at this meeting was the creation of a global reserve system. He had talked about Bancor. He understood that the adverse effects of the pound as the reserve currency was having on the UK. The US resisted the creation of a global reserve system. Keynes, though, succeeded in passing off the baton to the United States, and the United States became basically the global reserve currency. As I'll comment in a few minutes, I think it was bad for the United States. It's been bad for the world. The dependence of the global system on a currency of a single country and in a multipolar world of the 21st century is clearly a historical anomaly. And it's especially becoming apparent today because the dollar is not a very good store of value, looking at the problems, the crisis that it had brought to the world. So the dollar reserve system is unstable, it's deflationary, it's inequitable, and these are points that I've expanded on other occasions. Let me go on and point out that reform is even good, would even be good for the United States, even though it's resisting this good medicine. It enables the United States to borrow at low interest rates, and obviously, given the size of the deficits, it's understandable why it wants that. But the accumulation of reserves by foreigners means the U.S. is in effect exporting T-bills rather than automobiles. And the big difference between exporting T-bills rather than automobiles is T-bills doesn't give rise to many jobs. So in the past, the contractionary effects could be offset by government spending, but it's going to be more difficult for now, given the size of our deficits. In spite of the fact that it would be good for the United States and for the world, the U.S. has resisted change. But this is an example of where there should be a difference that follows from the changing global landscape. Because China has almost $3 trillion of reserves, and that it should follow from that, its voice should be more important. China knows that it's earning a negative return on dollar holdings. It's a wasting asset. And there are some reforms that could make a big difference. In the long term, annual emissions of a new global reserve currency, but even in the short term, something that could be agreed upon this year would be annual emissions of SDRs combined with reforms in SDR system to make the SDRs more usable. The global monetary system is the second topic I want to talk about. Basically, we've gone from the world that existed at the time that the Bretton Woods meeting was held, where there were very little capital flows, to one in which there's global financial market integration to a very high degree. And the implication of this is that if liquidity is created in one part of the economic system, it can basically flow anywhere in the world. And so what you're seeing exemplified today with QE2 is that money created in the United States isn't going where it should be going to stimulate the U.S. economy, a little bit, but not much, but much of it's going abroad. And that's what you would expect, because that's where the excitement, it's where the high returns are. And the American financial system has yet to be fixed. The banking system is still clogged. There's a number of elements of intellectual incoherence in the current set of arrangements. One way of thinking about it, I'll come back to it later if I have time, is that if you had a fully integrated global financial system, it would be a little bit like having an economy with multiple central banks. And that kind of system can't work. It was a kind of system that Russia tried in the days after the Soviet Union broke down, and it was a disaster. And that just is an example of one of several elements of intellectual coherence. Another example of intellectual coherence is that the model is being used like by policymakers and central banks and IMF before the crisis talk about risk diversification. Models assume a high degree of convexities that are associated with risk spreading. After the crisis, the words they always use are contagion. Contagion is associated with a kind of non-convexity. Now, a coherent approach would have talked about beforehand recognizing the dangers of integration. It's like when you create an electric grid, you are aware that a more integrated electric grid has the advantage of using your generating capacity more efficiently, but it has a disadvantage that a brownout, a blackout at one point in the system can bring down the whole system, as we learned in the United States. Unfortunately, the advocates of these full integration never understood this. I've written about this at greater length in an article that's just come out in the Journal of Globalization and Development and another article in the American Economic Review. QE2 is another example of a sort of intellectual coherence. There's a little bit of a digression, but it was announced as a temporary purchase of long-term government bonds, raising prices and lowering long-term rates. But as Larry Summers pointed out a couple of nights ago, people understand that it's going to be removed, and he said at that point, therefore there should be very little perturbation at the moment it's removed. But that same kind of logic should say there should be very little perturbation at the time it's implemented. There are other kinds of aspects of intellectual and policy incoherence. If it's permissible for one central bank to add dollars to stimulate the economy, why should it not be permissible for another central bank to subtract dollars, which of course is what exchange rate intervention is? More generally, governments are attempting to limit the potential impacts by imposing constraints in the free flow of capital. A whole variety of interventions, which, as I mentioned before, the IMF has now quietly semi-blessed. Let me finally talk about a new global regulatory regime. I'm told my time is up. Okay. Okay. Okay, a new regulatory regime. Okay, without global regulation, there is a risk of regulatory arbitrage and circumvention. That's why we need a global regulatory system. But the likelihood of an effective global regime is limited. And a lot of this discussion, we can't do anything until we have a global regime, by those who don't want any regime, is really an attempt not to have any regulation. My view is that each country has a responsibility to protect its citizens and economy, and adopting regulatory regime appropriate for their own circumstances, recognizing the large role that special interests, especially finance, has played in setting these national rules in the West and elsewhere. There's one aspect of regulatory regime, though, that we talked a lot about it during this conference, but one aspect that has not gotten sufficient attention is cross-border flows. It's a critical part of the regulatory regime. The countries that did not allow it fully, like China, did a lot better in the current crisis. And the evidence is overwhelming that these short-term flows are a major source of volatility. They're pro-cyclical, with little evidence of positive effects on growth. In fact, some evidence of an adverse effect on growth. And that there are a variety of effective capital account management techniques. And there's, again, a recent body of research, some of which I've contributed to, explaining why these adverse effects should not come as a surprise. And that's why I think we should be happy about the recent IMF report. It's a major policy shift. My concern, of course, is that it didn't go quite far enough. It says that it should only be used as a last resort, temporary, since they were given, put down in the lexicographic ordering. I think there was no persuasive reason for that. So let me talk about one other aspect of the regulatory system that one needs to think about, particularly in the aftermath of the crisis. Capital market liberalization is what focuses on the ability of capital to move back and forth across borders easily, causing instability. You can't use money that can be pulled out of the country overnight as a basis of long-term investments that create jobs. But another aspect that is aspect of liberalization that's embedded in some of the recent treaties is financial market liberalization, allowing banks to move easily across borders. And there's evidence, too, that this may have contributed to volatility without offsetting benefits in terms of economic growth. There's considerable evidence that international financial institutions are especially less interested in lending to domestic small and medium-sized enterprises, which are the source of job growth in any economy. And these results are not surprising, given the information asymmetries. I've written, and others have written a great deal about this. It's a long-term source of concern. In fact, if you go back in American history, there was a reluctance in the U.S. to have national banks precisely because of some of these concerns. And it was interesting, the U.S. was pushing for global financial liberalization before we actually had liberalized inside the United States. There are a couple of studies that I cite at the bottom of this of reports that show that financial market liberalization has had adverse effects on volatility and on lending. I want to conclude with just a few words about global imbalances. The U.S. tried to shift the blame for the crisis to Asia with words like a savings glut. The real failure was not that savings was too high. I still think savings is a virtue. If you look around the world, there are great needs around the world. Investment to retrofit the economy for global warming. We had a wonderful talk at lunch about that. The developing countries need huge amounts of money for infrastructure. There are huge investment needs all over the world. The real failure was with our financial system. Financial systems in the West, which didn't allocate the capital to where social returns were the highest and didn't manage the risk. So the bottom line of this is Asia, unlike the G20 view, Asia should not be encouraged to imitate America's profligate consumption patterns, although it needs to change its supply-driven economic model. The world, our planet, can't survive, and that was what, again, the charts that were given at lunch very strongly showed. The real challenge today, I think, is how to recycle the savings in a more productive way than has been the case in the past. And that necessitates the creation of risk mitigation facilities that I think should be an important area of research. Let me conclude. The new global order provides a new opportunity to design a new global financial and monetary system. The old system clearly hasn't worked. Principles underlying it were based on flawed theory. And Asia should work to create this new system. One of the ironies, just as an aside I should mention, is that any regulatory system needs to focus on systemically important countries to make sure that those countries are well behaved. The unfortunate thing is the systemically important countries, large countries like the United States, are the ones that you can't regulate. So the only one that the international community has been regulating are those that are systemically unimportant. I think it's going to be difficult to get a global agreement exactly for those reasons. And then meanwhile, I think it's important for Asia to resist the allure of financialization. China, one sometimes hears, seems to be attracted by the prestige of having its currency become used internationally. It will inevitably happen as China becomes the largest trading economy. But it does not require the full liberalization of financial and capital markets. And most importantly, internationalization of the currency is less important for China than developing good financial markets domestically, for instance, to provide credit to small and medium-sized enterprises. Finally, the notion that once its capital and financial markets have become more developed, it should fully liberalize is wrong. A lot of people have thought, well, this stage of restricted capital markets is only a stage on the way to imitating the kind of unfettered markets that have gotten us into the trouble that we are in now. The unfettered financial markets have never worked well, and the most recent crisis provided further evidence. That doesn't mean that there won't be reforms, and that there will need to be reforms to make their markets more efficient, more dynamic, but that the notion that the objective of this would be unfettered financial markets seems to me fundamentally flawed.